very excited to welcome back to Forward Guidance Darius Dale, founder and CEO of 42 Macro. Darius, great to have you back.
Jack, it is a pleasure to be back, man. I love the show. You've been cranking out some awesome content, my friend.
Thank you, Darius. The pleasure is all mine. I really want to ask you, how are you seeing things? We're filming this on March 22nd. I mean, there are so many things. The market is going all over the place. Options expiry, gyrating up, gyrating down. We've got monetary tightening. Now the Fed funds rate is at 25 basis points. Last week was the FOMC meeting. We've got stuff going on in Russia, Ukraine, and China. How are you making sense of it all, Darius? What are the risk and rewards that you see in markets?
Yo, that's a great question, Jack. So let me start by summarizing our views and summarizing them across durations, because obviously we have different investors living with different time frames and different asset classes and products that they trade. So I'll start from the longest duration, furthest out, kind of 12 to 12 months or so from now. We do believe the U.S. economy is slowing to a below trend growth state. I think a recession is a reasonable probability. It's very early in that process of assessing that kind of risk, so it's unclear whether or not we will wind up in a recession. I can see several indicators starting to point in that direction. So if you're thinking about kind of when that might land on the calendar, first half of 2023 would be that risk. From a medium term perspective, we think the growth slowdown in the U.S. and global economies is not something that's been priced into asset markets yet. And quite frankly, it hasn't had to be priced in asset markets yet, mostly as a function of it having not materialized yet. I mean, growth is still, if you look at it from a coincident to lagging indicator perspective, is extremely robust, particularly in the US and Europe. When you look at it on a leading indicator basis, however, they're obviously continuing to slow and getting to some pretty bombed out levels if you think about stuff like consumer and business confidence. So our view from a medium term perspective is that consensus will wake up to a growth slowdown that is materializing and ever present by the middle of this year. Our model specifically points to kind of the May, June, July timeframe as when that process will really start to be observed in the data. And so that is the big shoe to drop that is still in front of us as it relates to market pricing and more volatility. But the last one from a short-term perspective, and who knows how long short-term might last in these crazy markets. But we have a compendium of indicators that we look at from a short-term risk management perspective. That's sort of separate and apart from our fundamental views, and those indicators are quite positive. One of those indicators we call our cross-asset correction risk indicator. It just came out of a sort of what we call our consensus fear zone, which is basically everybody's bearish. And typically when we, roll out of that consensus fear zone, what tends to happen, I mean, this is, rolling out a sample back test going back decades, multiple decades, that tends to be a buy signal. It tends to be a fairly durable bottom in the stock market, from a medium term perspective. So we definitely want to respect that. Another signal that we're looking at is through the lens of our crowding analysis, where we kind of show the relationship between the deviation in skew and the deviation in volatility risk premium across most assets. And when you look at U.S. equities, risk assets, global equities, the preponderance of those exposures, across the kind of spectrum of risk, they're all kind of in the quadrant or in a state, in a derivative market state that tends to suggest that it doesn't pay to continue shorting these types of exposures. You're not getting paid to take those shorts. If anything, the big risk is to the upside in that respect. So, short term, I wouldn't necessarily we're bullish, because I think that would be a misnomer. I don't think we're ever going to be bullish until the Fed pivots dovishly, and that's unlikely to happen in any time over the next few quarters. But certainly could see some more upside risk in markets over the very near term. But medium term, long term, I mean, the Fed put is much lower than I think the average investor realizes.
So everyone's bearish, and you think that they have a reason to be bearish, medium term, long term outlook. You are bearish, but because everyone is bearish in the short term, that gives a lot of potential pop in the market if people have to take off their hedges, right?
Yeah, they absolutely did. And we saw that with last week in the FOMC meeting. That was the March 16th FOMC meeting. Yep. So we, last Friday with operations expiry for index options, we saw about a third of all index gamma expire. Obviously, mostly put options expire. And that was what catalyzed that kind of process of the Vanna and Charm flows into last Friday's OPEX, and then the sort of relief that we're getting here this week is a function of all that sort of that put exposure, that short put exposure on the dealer balance sheets, kind of evaporating really, for lack of a better word, and really perpetuating markets higher. And kind of this week was always going to be extremely critical from a risk management perspective because we knew that was going to happen. But will we see investors rush to put on those hedges again this week and next week? Kind of in the absence of potentially kind of feeling like they're swimming naked. We have not seen that rush to put on those hedges, and part of the reason we have not seen that is because the geopolitical situation is not getting any worse. We're starting to see some rifts in Europe as it relates to the response in sanctions terms to Putin's aggression in Ukraine, but also the growth dynamic is not yet, slowing at a pace that would indicate there's a tremendous amount of downside risk for the market over the near term. So what I'm saying in so many words is the lack of a fresh bearish catalyst or a series of fresh bearish catalysts has suddenly become a bull catalyst in the context of that extended bearish position.
That makes sense. Darius, the last time we spoke in January, it seems like it was, a year ago.
I know, right?
What since then has played out pretty much exactly as you predicted, as you foresaw the probabilities, and what has surprised you the most?
Yeah, great question. So I think you and I we recorded in late December. Back then we had a view that look, the Fed, both the monetary and fiscal authority, because I think now it's pretty clear that we're not getting any fiscal stimulus in the U.S. But I do believe there was a healthy debate back in Q4 whether or not we were going to get incremental fiscal stimulus in the U.S. We were very much on the view. We very much had the view that we would not see incremental fiscal stimulus. We also had the view that the Fed would be tighter than consensus expects. Both of those dynamics have really played out in spades. If anything, I would argue the Fed's been even more hawkish than we would have thought in terms of their policy rate guidance. Particularly this most recent dot plot projections. Prior to that, they're probably in line with where we thought, but this most recent dot plot projection is quite hawkish. If you think about the 2-year out dot, finally going into restrictive territory, it's the first time we've seen that since 2018, and we all know how that ended. So that certainly has gone along according to plan. But what has not gone along according to plan, and I'll be the first person to take the heat for this because there's certainly been a chorus of us bond bulls out there, but I'm happy to wear the kind of the dunce hat for now. We just got that wrong. I mean, quite frankly, the bond market responds, and we can unpack this. I'm sure you're going to want to for the listeners, but the bond market responds to the cyclical deceleration in the economy, the confluence of the Fed tightening into that cyclical deceleration in the economy has not gone according to plan. Historically speaking, that's been a very, very positive, environment for markets or for bond market. If you look at the long bond futures, we back test everything through the lens of our great asset market, back test process, where we're kind of thinking about the economy through the lens of growth, the change in growth, the change in inflation, all these different dynamics on the policy side as well. And when growth's slowing, you tend to have an 11% annualized return in bonds, bond prices. When growth's slowing and the Fed's hiking rates into that slowdown, that return dips down a little bit, but it's still a +9. And when the Fed is, kind of slowing, when the growth is slowing and the Fed is doing quantitative tightening, it's still a +9. We've obviously gotten the opposite of +11 to +9 in terms of that range on bond prices. And so it's telling you that there's something else that's being priced into the long end of the Treasury curve. And my view on that is still developing, but I think one thing that is important to call out here is the sort of breakout in structural inflation expectations in Europe. If you look at something like the five-year forward euro inflation swap rate, that number's up at like 220, just shy of 220 basis points or 2.2%. That's the highest level we've seen since 2014. And so that's telling you, I'll beat you to your own question. You're going to say, hey, what's the five-year forward inflation swap rate? You're really good at asking questions to simplify things. That's looking at the market's expectation for inflation, for the average inflation rate 5 years after the next 5 years. So kind of like the second half of the 4 or 10-year window, if you will. And so that,
so like 2027 to 2032.
Bingo. Exactly.
Yeah.
Exactly. And so the fact that the market is saying, hey, look, these structural long-term inflation expectations in Europe are not only rising, they're breaking off the top of the chart. And so to me, that is saying, hey, look, there's going to be a fiscal response to the energy and defense crises in Europe. That fiscal response is likely to catalyze some, longer term infrastructure development, both, in the oil and gas front, but also in the terms of, reshoring some of the manufacturing capacity, to the extent that, China and Russia try to, kind of, marry themselves together, if you will, in this longer term project. So, I think that's what the market is telling you is that, hey, look, there's going to be a lot more inflation in Europe over the longer term than we're used to. And this is very different than the ECB policy setting, which is perpetually in negative territory. If you think about the main refinancing rate, you think about German bunds barely being positive yielding for an extended period of time. If you reprice that entire sovereign debt curve higher, well, guess what? You have to reprice the entire U.S. sovereign debt curve higher, and as a function of that, the entire global sovereign debt curve higher in terms of interest rates. And so I think that's part of what's happening in the Treasury market right now. That's preventing the normal response of the bond prices to the Fed tightening into an economic slowdown. But eventually, we do believe that economic slowdown will come home to roost in bond prices and bond yields. And so, we're content to maintain that view.
So you talk about long-term inflation expectations. Even though we had breakaway inflation in 2021, U.S. bonds actually had a bull market because long-term inflation expectations stayed relatively anchored. You're saying now the fact that those long-term inflation expectations are breaking out of a range, particularly in Europe, indicate fears, worries that we would enter not just a cyclical period of inflation, not just a spout of inflation, but a long-term secular inflation, which of course is like anathema to the bond market. I take it, given that you still are into bonds, that you don't believe that we are headed for secular inflation.
When I hear something like secular inflation, I think the average investor can go somewhere between like a range of like the 1940s or 1970s to something that maybe looks more like kind of the late 60s or the mid 2000s. I mean, that's a wide range of inflation outcomes. They're all inflationary, but that's a pretty wide range. I mean, we built a model here at 42 Macro called our secular inflation model to dynamic factor model that looks at 16 sort of core macroeconomic variables that all have a high co-integration or correlation with inflation over multiple decades. And that model is suggesting that the stationary mean or the average of inflation should be somewhere around or somewhere in the range of 2.5 to 3% in this decade, in this current decade. That's roughly 50 to 100 basis points higher than it was kind of in the prior decade. So that's a meaningful shift higher. I mean, if you think all things being equal, and obviously not everything's equal, but all things being equal, you should think bond yield should be somewhere between 50 to 100 basis points higher on average in this current decade, right? And so that's kind of like that's what our model's view on the kind of longer term inflation dynamics. Now that doesn't mean that bonds have to go down in price every day for the next decade because inflation is going to be higher in this decade. Obviously, bonds are still going to have they're still going to have to deal with their cyclical dynamics, growth accelerating, growth slowing, inflation accelerating, inflation slowing, Fed cutting rates, Fed hiking rates. All those cyclical dynamics will continue to drive the boat from a medium term perspective. But just this longer term perspective, I think we were in this moment here in the first kind of part of 2022, where the entire bond market had to reprice higher in yield terms, lower in price terms, to acknowledge everything I just said about these changing inflation dynamics, not just in the US, but also in Europe.
Let's go back to January. You were viewing bonds. People view bonds as a way to hedge equity risk. When equities go down, bonds go up, meaning the prices go up and the yields go down. In a sense that you were looking for an equity hedge and that you had a risk-off period, you were completely right. You nailed that. But like so many other investors, relying on bonds as a hedge against equities, bonds just weren't there. What does it mean, Darius, if we put up a chart of the S&P 500 relative to TLT, the fact that they went down together, that's really not supposed to happen. What does that mean to you? Does it indicate anything about the period of inflation that we're in?
Yeah, great question. So going back to the secular inflation analysis that we're talking about in the models that we built, when you go back and you sort of study the covariance between bond prices and stock prices, what you find is what's pretty clear and evident in the data is that when inflation, headline inflation, and then again I'm using the U.S. as a sample here, when headline inflation is north of 5% and persistently north of 5%, bonds and stocks tend to have a positive correlation. Now, what's special about 5%? I have no idea. I'd be the first to tell you that it's just an empirical observation rather than, I think, an economic theory. But for whatever reason, it tends to be a positive correlation between long bond prices and stock prices. That correlation, that positive correlation, really broke down in the late 90s as kind of partially as a function of the Fed getting inflation under control and the market really kind of believing that in longer term inflation expectations. But I also think another thing happened in the late 90s that is kind of under discussed as it relates to the current Fed regime, or at least the most recent Fed regime we're in. I think right now we're in a different Fed regime. And the most recent Fed regime that we're in was one that where deflation and the financialization of the economy and ultimately the feedback loop between the financial markets and the economy was the main priority of the Fed, kind of because inflation was no longer an issue. And we had these sort of extended, elongated economic cycles as a function of inflation no longer being an issue. And so that all kind of came to fruition with the Fed bailout of long-term capital management after quote unquote, after coincidentally the Russian default in 1998. So just keep that, go back and study that if you haven't really studied that part of history, because I do believe it's really important. But as it relates to kind of where we are today in this inverse or correlation between bonds and stock prices or lack thereof, well, guess what? We have inflation at 8%, or headed towards 8%, or just shy of 8%. Could be on its way to 9%, maybe even 10%. If we see a big rebound in energy prices from here, we're certainly positioned for that. It's very unlikely we see that inverse that inverse correlation really start to pick up until that inflation momentum wanes, until the sort of view until we see a peak in European policy rate expectations. And you're not going to see a peak in European policy rate expectations until inflation peaks in Europe, which we have that I think is a second quarter event, or until the growth slowdown in Europe really starts to materialize and shows up in kind of the coincident to lagging indicators. And that's something that we expect to be in Q3, expect to see in Q3.
So if bonds can't be relied on as a way to hedge equity risk for at least a few months, as you say, then where can investors find safety? Where can they buy something that will go up when stocks go down?
Yeah, I mean, so one of the ways we've taken advantage of that is kind of targeting the medium term, like VIX futures. So obviously front month VIX has been extremely elevated, not only relative to realized, but also relative to longer dated contracts. There's been a real persistent backwardation in VIX, or not persistent, but it's certainly kind of trended thus far throughout the year. So that's been a place to go. Obviously, part of the reason we're seeing stocks declines in this particular window is we're seeing kind of commodity price spikes, commodity price shortages. So for a while there, the crude oil had become the new VIX, right?
Yes.
Or sort of different pockets of the commodity space. So that was another way to go. But I mean, I say this very simply, like depends if you're a retail investor or institutional investor, because the answer to those questions are very different. Institutional investors obviously have to maintain, kind of fully allocated position portfolios. And so within those kinds of portfolios, you're going to want to be targeting defensive sectors and style factors in the equity market. You're going to be reining in your credit risk in terms of your fixed income portfolio. You want to be going kind of out on duration, reining up your credit risk. That tends to be kind of how you take advantage of financial market volatility as a professional investor. Obviously, if you're a currency trader, buying dollars, buying gold, buying Japanese yen and Swiss franc are the kind of ways to go there. If you're a retail investor, the simplest thing to do is do less of what you were doing in the last couple of years, i.e. raise cash. I mean, we're coming out of a very aggressive, to the upside, very positive economic environment that perpetuated some very bubbly charts. I mean, we were talking about this, I was up with your colleague, your former colleague Ed Harrison, talking about this in Real Vision in the fall of 2020 and said, hey, look, man, there's about to be 5 things happening that almost never happen at the same time. You're going to have growth accelerating, you're going to have inflation accelerating, you have corporate profits accelerating, the Fed easing aggressively, you have fiscal policy easing aggressively. There have been like 10 quarters since 1960 where all 5 of those things are happening at the same time. And obviously those are some of the best quarters in financial market history if you think about the stock market returns and stuff like that. We got 2 of those quarters in the first half of 2021. And so obviously all the charts that, started to really break out in November on the vaccine news and the unwind of the, election hedging, all that stuff perpetuated some aggressive bull market breakouts in pretty much everything from crypto to NFT to Cathie Wood stocks to, energy stock to everything. Everything was a gigantic bubble. Well, guess what? All 5 of those things are going in the reverse direction, and certainly will be headed in the reverse direction by the time we get into the second half of this year. So if you got a bubble across pretty much every, liquid risk asset class, and even in liquid asset classes, obviously we've got a housing bubble as well out of that. We got bubbles galore as a function of those dynamics. Well, guess what happens when those dynamics go in reverse? A couple stats for you, right? Like when the S&P 500 is slowing, as fast as we expect it to slow in the back half of the year. You're talking about a just shy of 20% annualized decline in terms of S&P, but that's roughly around minus 40% for something like S&P 500 high beta index. I mean, you're talking about orders of magnitude of that for crypto. So it's going to be a tough, challenging market for a lot of investors to trade, because I don't think the average person does enough work to understand that a lot of those big cyclical factors are going to be moving in the wrong direction, and pretty much moving in the wrong direction for an extended period of time.
And could you just list again those five factors? You listed them in 2020, but now that they're in reverse, what are they again?
Yeah. So in 2020, we're talking about this. This is October, November 2020. We're saying, hey, growth's going to be accelerating, inflation will be accelerating, corporate profit growth will be accelerating. So three cyclical factors that are positive for various segments and sectors of the market. But then you also had, very aggressive monetary easing and very aggressive fiscal easing. So it's like, man, like the Fed and the Treasury are pro-cyclically stimulating into a cyclical recovery. Well, now the Fed and the Treasury are pro-cyclically tightening into a cyclical slowdown. So the Fed is going to remain actively engaged in tightening monetary policy for an extended period of time. And the only thing that's going to cause them to pivot is financial conditions. Financial conditions become so tight that the obvious conclusion is that inflation is very clearly going to decelerate very rapidly. And that, in our opinion, is probably a Q3, Q4 event.
And how bad do you think things have to get? How much do financial conditions have to tighten? How wide do credit spreads have to get? How much lower does the stock market have to go before the Federal Reserve has another, Powell pivot moment?
So I'll start with the short answer, which is our model suggests somewhere around 30% peak to trough decline in the S&P 500. And we get to that number in a variety of ways. And I'll try to be quick here. So from a business cycle perspective, let's start by saying, hey, look, the Fed is starting to hike interest rates as deep into the business cycle as it ever has. If you think about it, looking at it through the lens of the level of the unemployment rate, the Fed has never lifted off its monetary policy rate, or the Fed funds rate, with the unemployment rate as low as it's ever been. This is data going as far back as we can get the data for both the unemployment rate and the Fed funds rate. We've never seen the yield curve as narrow as we have seen if you look at 10s, 2s prior to liftoff. So both from a financial market perspective, but also from a realized labor market perspective, the Fed is starting this process of pulling back the punch bowl way too late. They should have started over a year ago, right? As soon as they passed the Biden fiscal spending program, the Fed should have said, oh, no, wait, this is going to overheat the economy. Let's start pulling back on stimulus. Nope, they waited a whole extra year. And guess what? Now we have to deal with it as investors. So kind of answering your question in terms of where's the Fed put, there's kind of three main indicators we look at to kind of gauge financial market risk, or sort of not even financial market risk, main indicators to gauge kind of like the size of the drawdown we could see in any given sort of market event. There's the business cycle. We look at that through the lens of the Conference Board labor differential index, that kind of is a proxy for how good is the labor market relative or how good are labor market expectations relative to how good or how fast is it likely to deteriorate. So basically, we're coming off a cycle peak in that number. There have been 8 or 9 cycle peaks since the 1960s in this indicator, and every single one has coincided with a big drawdown in the stock market, and the median drawdown is minus 35%. So that's number one, minus 35%. Number two.
Sorry, the catalyst for that is monetary tightening?
No, the catalyst for that is the labor market cycle, the business cycle slowing. So we're already slowing in terms of that indicator. Obviously, you need to slow a lot more than off the cycle peak to really kind of kick things going from an asset market response perspective. But we're certainly underway. I mean, we're very clearly slowing off a cycle peak from the perspective of the labor market. From the perspective of positioning, we look at household equity ownership relative to overall net worth, and that ratio is at an all-time high of just shy of 30%. So we're peaking at just shy of 30%. When we get the Q1 data, obviously the number is going to be off of that all-time high because the numbers through Q4. And there've been, I want to say 16, there've been 19 of these cycle peaks since going back to the 1940s in this particular indicator, and the median S&P 500 drawdown off that cycle peak is minus 22%. So you got minus 35%, minus 22%, and then the last one, if you look at it through the lens of valuation, you take the S&P 500's earnings yield, so the earnings divided by the price, and then subtract headline CPI, so you get the real earnings yield. You could also do this with, consumer confidence, inflation expectations. You get to the same answer. Whether you use realized headline CPI or whether you use consumer confidence is irrelevant. What is relevant is the fact that we're as negative as we've ever been in this particular indicator. And historically, whenever we've kind of inverted in this indicator or gone negative, so to speak, the median drawdown in the S&P has been 41%. 41%. And so we're negative in the minus 41% category. We're rolling off an all-time high in the minus 22% category. And we're very clearly rolling off an all-time high in the minus 35% category. So if you look at it through, again, business cycle, positioning, valuation tells you that there's a lot of market risk in this market. And oh, by the way, this is the Federal Reserve doesn't care. They do not care. Inflation is the main priority.
This episode is brought to you by BCB Group, Europe's leading provider of crypto-friendly business banking for institutions in the crypto space. They also provide trading services allowing you to trade FX and cryptocurrency quickly and at scale. They specialize in efficient execution of large orders in illiquid markets. So if you are an institution looking to make high volume trades, you need to check out BCB Group, because a great trade idea is worth nothing if you can't execute it. And that is exactly what BCB Group helps you to do. Their mission is to empower the global financial revolution through sustainable and innovative banking. Really glad to have them as a sponsor. So if you want to take control of your digital assets, please check them out at bcbgroup.com/Jack. That's bcbgroup.com/Jack. Thank you, and let's get back to the show. Yes. Darius, very interesting what you said about the real earnings yield for the S&P 500, which you said was at an all-time low or close to an all-time low. What about the real earnings yield for, let's say, the 30-year U.S. Treasury yield? If you take the 30-year yield, that's, 2.3, 2.4%, and you subtract 7.9%, that's a pretty low number. And it might be an all-time low. What does that suggest about bond yields? Is there a drawdown that you see when real bond yields are this low?
That's a good question. I'd have to answer that question for you. I would imagine, yes, you're probably right. Like anytime you have such a negative starting valuation, if you look at it on a long enough time horizon forward, you tend to have negative adverse consequences in markets. So I would imagine it's pretty bad as well. Although, but again, you still have the cyclical component of bonds, right? Unless unless you're talking about isolating the back test to the 1970s, which you could in theory if you wanted to, you're not going to get that sort of kind of dual simultaneous declines in stocks and bonds outside of that time horizon.
Darius, so I want to ask you about gold, because for a long time, over the past year or so, I've been asking you about gold, sort of trying to tee you up to say gold is is going to break out, because you always said something that I thought would be coincident with a constructive take on gold. But you always resisted me, Darius. You never you always said gold, I like it, but it's not this juncture. And you definitely avoided a lot of pain in the gold market, because 2021, like the latter half of 2020, was kind of a disaster for gold. But it's my understanding, Darius, that finally, at last, you now see you've taken a shining to gold. Tell us why that's the case.
Yeah, so it's consistent with our views on the cyclical aspects of the economy. Gold tends to do really well when you're having a growth slowdown. The sort of annualized expect. In fact, when growth's slowing cyclically, i.e., you're in inflation or deflation from the perspective of our great asset market framework, gold is one of the best places to be. And it's I think about a 10 or 11% annualized return in those regimes. Gold also tends to do quite well when the Fed is tightening into the slowdown. Gold has a very similar return profile as a long bond. And so obviously with the long bond kind of under siege here, just as a function of the change in your longer term European inflation expectations and obviously the repricing of sovereign debt in Europe, bonds are kind of doing their own thing right now that eventually I think they'll recouple to the gold price chart. And ultimately we'll see a lot more positive performance in those types of defensive assets kind of as we progress throughout the year. But for now, we're definitely very positive on gold.
And what about Bitcoin, Darius? It might seem counterintuitive because, Bitcoin benefits so much from the Fed's balance sheet and all these things. But historically, Bitcoin actually, the epic bull run of 2016, 2017 was during a quantitative tightening cycle as well as a rate hike cycle. So what does sort of your back test say about the risk reward for Bitcoin at this juncture? And what are you thinking about that? As well as you can also talk about other digital assets maybe.
So the first thing I'll say is 2016, 2017, growth was accelerating both domestically and globally the entire time. The global economy, from a leading indicator perspective, bottomed in Q1 of 2016. And I think the U.S. economy bottomed in Q2 of 2016. So that massive bull run we saw in Bitcoin was really a function of the growth dynamic accelerating. And again, this is consistent with all our back tests. It's not whether the Fed is tightening or easing. It's whether they're tightening or easing into cyclical accelerations or cyclical decelerations. And so for something like Bitcoin, the annualized return on Bitcoin, when the Fed is tightening into a Goldilocks or reflation regime, is still going to be quite positive. I mean, probably triple digits positive. I have to confirm that with you with your listener after the show, but I imagine it's probably triple digits positive, in so much that when the Fed is tightening into a slowdown, you're probably somewhere very high double digits on a negative basis as well. So, and that's kind of the setup we are still in, right? I mean, I mentioned at the onset of the show, kind of from a very near term perspective, there's really no more bad news to shock Bitcoin below 40,000, or shock the S&P below 4,100, or kind of things of that nature in the very near term. Over the medium term, obviously, we spent the last kind of 45 minutes talking about the kind of negative cyclical and structural aspects to this market. From a Bitcoin perspective, in the absence of negative news, then you have to understand that, hey, look, man, there's a lot of speculation in this asset class. There's a lot of people chomping at the bit to buy what they believe is a cheap Bitcoin price chart. I don't want to fight that, certainly in the context of CAC exiting its consensus fear zone, in the context of the chronic analysis we cited at the onset of this discussion. I certainly don't want to fight that. If you look at, kind of Bitcoin and Ethereum price charts to begin with, they didn't make new lows going out off of January, right? Like they held in those January lows and have been consolidating, and they look like they either want to break down a lot or break out a lot. And in the context of not having a lot of negative news for the next few weeks, or even a couple of months potentially, I would imagine that the probability of breaking out a lot is higher than the probability of breaking down a lot. So again, we're not long or short crypto at this particular juncture. I just as soon, I tweeted that this morning, that if we do see a breakout, because obviously you have the Ethereum 2.0 catalyst hanging out there as a potential positive for crypto. You got Bitcoin conference down here in Miami in a few weeks. Like, there's going to be some positive kind of catalysts, just from a headline perspective, that can get you some positive price momentum. And I just assume be the second person into that trade, right? This is not the kind of economic or market environment where you want to be taking a lot of aggressive bets. As I mentioned, those 5 factors are moving in the wrong direction, or at least 4 of the 5. Right now, inflation is still going up, obviously, but eventually, by the middle of this year, inflation will be going down. This is not the kind of time to be, hey, let me go take a 10% position in some altcoin. This is just not. I do believe you can selectively kind of trade, risk assets like Bitcoin and Ethereum to the long side if you get some confirmation. That's a big if. It may come, it may not come. I just assume wait to see that confirmation come, though.
Darius, what about oil? I wouldn't be surprised if oil and other commodities trade very poorly during a cyclical slowdown, like the type that we're in, and like the type that you forecast for the next few months, if not year. But oil has actually been on fire, and it's my understanding that you're actually somewhat constructive on oil at this time. To what degree does that have to do? Are you kind of a student knows all the rules, but a master knows when to accept the rules, make exceptions, essentially? To what degree are you sort of saying, okay, my macro model, my back tests say this, but just what's going on in Russia, Ukraine, and the supply dynamics, you got to have some exposure to oil. What are you sort of thinking here?
Yeah, no. So I mean, we're still in stagflation, and stagflation, or what we call inflation in our grid framework, is a positive dynamic, or positive regime for oil. Particularly when you're having these sort of big inflation shocks and commodity price shocks. We saw that in all 3 recessions in the 1970s. We saw it obviously in 2008 in the global financial crisis, where energy prices, oil, energy stocks, did well in the recessions, like in the actual recessions, as a function of kind of the supply demand imbalances. I don't want to get too far over my ski tips talking about supply and demand, because that's not something I spend a tremendous amount of time or have the bandwidth to focus on. My core competency, my bailiwick, is understanding the growth, inflation, and policy cycles, understanding positioning, understanding changes in derivative markets that create opportunities in financial markets. And one of those things we saw, hey, look, we saw an opportunity to get long crude oil and get long of get long crude oil, get long of energy stocks, and taking advantage of the kind of big drawdown we saw recently. We sold it really well, actually. We bought it in January as a counter-cyclical hedge to some of our equity exposure. It worked out. It paid off really well. Booked like a 30-something% gain in a matter of weeks. Sold off, bought it back. Hey, look, man, we'll give it another go, and we're going to keep giving it another go. Outside of the context of our broader kind of grid asset market process, because again, we do believe that there are opportunities at times to kind of become the master and say, hey, look, there's an opportunity. The market's giving us a real shot here. Oil below $100 a barrel is a mispricing relative to the kind of the structural supply demand imbalances that we all come to learn as a function of really smart people in your program and other programs kind of teaching us those dynamics. I'm not going to fight that in so much that I'm not going to overstay my welcome. It's probably would be the last time we're going to be long oil if we sell it from here.
Yeah, I think when you got back into oil, I think you pretty much nailed the bottom of March 14th. If someone's listening now and hearing your macro framework, your outlook on risk, on a cyclical slowdown, people say, okay, I'm going to get 50% in cash, 50% gold. Why might that be not the best allocation, and why, as you look at equity market, why do you own stocks at all, and what pockets of the stock market are you see as greater risk reward than others?
Yeah, I mean, I guess if you wanted your portfolio to reflect like a point 0.5 beta to the gold price, then that would be a perfect allocation, right? Like if you're like again, I don't really have a frame of reference to say that is a good or bad portfolio. It's not a portfolio. It's just a point 0.5 beta to the gold price if that was your setup. Maybe someone wants that. Maybe that's a good idea for someone. I don't think it's a good idea for most people. It's certainly not a good idea for institutional money managers. It's probably half of our clients, so I'm never going to recommend anything that looks like that. But I do believe there's an opportunity here. Like as we get further in the year and the liquidity dynamics continue to get tighter and tighter and tighter, more and more assets are going to find it very difficult to appreciate in price. I mean, that's just what it is. I mean, this is how the market cycle works. When the liquidity spigot is open, you can go buy like, I don't know, Kuwaiti bonds, like a Tanzanian, currency, like that, those kinds of things go up in price when the liquidity spigot's on, and those things go down in price a lot when it gets turned off. And as long as it stays turned off, you start to lose pockets of the market. Liquidity dries up at the margins, it dries up at the fringes, and eventually it comes home to roost in the main primary asset classes. And that's something we're going to start to see, as we get deeper into the spring and into the summertime. Let's play this forward, right? In the most bullish near-term scenario I can kind of paint, let's say Ethereum and Bitcoin break out and everyone's high-fiving at the Bitcoin conference, and the Ethereum 2.0 thing is a raging success, and S&P's back up at 4,800. Again, it's May and it's time to sell in May and go away. And by the time you look underneath the hood in May, you're going to say, hey, well, look, breadth is not as good as it was 2 months ago. Kind of like altcoins aren't doing as well as we thought they would in this kind of quote unquote, renewed crypto bull market. Like this is how it looks, when you're talking about being in a structural bear market, as I believe we are still in. This is a structural bear market. There's no question about it. If you look at kind of the trend in volatility, you look at the lack of breadth, you look at the leadership within the market. I mean, two things, another thing we haven't talked about yet. We're supposed to have, going back to this elevated consensus expectation on growth, we're supposed to have this like post-pandemic services sector boom, right? Where there's all this cash on the sidelines that, the government gave us and we're going to spend all this money. And, you pull up a chart of leisure and hospitality stocks or airline stocks, and it's like, where in the hell is that post-pandemic service sector boom? Oh, wait, it's not happening. Oh, no, wait, Darius is probably going to be right on this below trend growth slowdown. Oh, no, wait, it's not just Darius. It's the whole freaking U.S. Treasury yield curve. And so I do believe those chickens are going to come home to roost, but they don't necessarily have to come home to roost tomorrow. It's going to be a process.
Well, Darius, in terms of the prices of the stocks, in terms of the yield curve, they're just singing the song that you're absolutely right. Like the hotel stocks are down, airline stocks are down,
Restaurant stocks are down.
I don't know.
I mean, they're some of the worst charts in the market, and that to me is like that's a very negative signal if you're talking about what would we bottom? Let's not sure what the actual low of the market is intraday, but let's call it whatever the most recent low was. If you believe that was a durable market bottom, like I can put money to work with a 6 to 12 month view on that money, I think you got to go back and check those charts that we just highlighted and say, hey, that's probably a very big warning sign for that not being a durable bottom. So definitely see a lot of downside risks over the medium to longer term. Over the very near term, the coast, I wouldn't say the coast is clear because that might be misinterpreted when you put it in words, but I certainly don't see enough negativity forming in the very near term.
And some of the few stocks, Darius, that are down more than those stocks you mentioned, the reopening stocks, in some cases much more, are the hyper growth technology names, the poster child for this is ARKK. I think when we did our interview in late December, which aired in early January, you said one of your predictions was that ARKK, it's easy. You sell ARKK and you buy Apple or something like that. How have you viewed that prediction to play out? I think Apple probably down since then, but ARKK down so much more. And why do you think ARKK is down? My reason has to do with duration. I think it's kind of ARKK is down for the same reason that TLT is down. It's inflation. You maybe are a little bit more in the high beta camp. So just break us down how you've seen this huge bear market develop, and just, the bull market sort of incinerate in these technology stocks, as well as your outlook on the future.
Yeah, so I mean, it's both a confluence of duration and also a fact that whenever the market's going down or volatility is rising, you're going to have high beta securities, crypto, high beta stocks like ARKK or ARK, if you will. They're going to go down a lot more than the broader market. I mean, that's just the nature of the beast. If high beta means it goes up a lot more in the broader market in the bull market, and it goes down a lot more than the broader market in the bear market. I mean, that's as simple as that. In summarizing the quantitative aspects of that characterization. So yeah, and I mean, we're still short ARKK. I'm very nervous about being short ARKK here, to be very frank, because again, we're seeing some of those positive, short-term market dynamics, unfold in front of us, and I don't want to be caught short for what could be a multi-month squeeze. It's one thing to look at a chart and say the chart went from here to here and gloss your eyes over all the wiggles in the chart. It's another thing to actually backtest it, relate those movements in the chart to other movements in the economy and asset markets, understanding the timing with which variables are released in calendar terms, in economic terms, on an ex ante, out of sample basis. When you actually have to construct those backtests, you realize, man, this was not a linear path. Like everybody got carted out from March to May '08. Nobody was able to stay in the trade from March to May '08. That was a massive bear market rally in March to May '08. You also got a massive one, I want to say, from November '08 through January of '09, before the bottom fell out again. You had these massive rallies in 2001, late 2001. Was it late 2000 into 2001? Then you had another one in like early 2002 in that multi-year bear market. Like, you have these massive bear market rallies, and so you have to respect the fact that, hey, look, nothing happens in a straight line with respect to pricing in a cyclical upturn or a cyclical downturn. Bull markets correct, bear markets have rallies, and so we have to understand that and deal with that as investors, and just not get too far out of our ski tips in terms of taking risk or reining in risk at various intervals.
Yeah, so Darius, because you said you're short, I know that what ARKK did on FOMC day 6 days ago.
Yeah.
Up 10%.
Yeah, that was not fun. That was not fun.
That's exactly. Like, I don't know what's more brutal. You have a stock go up 20% when you're short in a single day, or is it more brutal to have it go 20% up over the course of a month or 3 months?
No, you'd rather have it happen quickly, so so a signal can trigger quickly, so you can get out of position quickly. You don't want to. I mean, you can just bleed over the course of many months and not really get the signal to ever exit the trade, or either book it a gain, book it a smaller gain, or book it at a loss. I mean, I just as soon get out of a trade if the signal's changing, and I just as soon find out that the signal's changing sooner rather than later.
Darius, what do you think the yield curve looks like in a few months? Now it's changed so much since we spoke last. The 210 spread has flattened dramatically. The 35 spread has flattened. If you look at the forward market, some of them are actually in inversion now.
Mm-hmm.
A lot of
the cash market. I mean, like 7s, 10s, 5s, 10s. There's inversion coming, and you typically don't see this kind of inversion. I was listening to a podcast with Jim Bianco recently, and it might have been on your program actually. He was saying, look, when this stuff happens, it's not like a one-off or this, this like, oh, haha, sorry, we inverted, but we didn't mean it. No, the whole curve is about to invert. The economy is about to go into a cyclical slowdown. There might be a recession on the back end of it. And oh, by the way, the markets are not done pricing that in yet. That's as simple as we can make it.
And how do you think that plays out? Do you think that the front end, let's say the 2-year, has any further to go higher to price in more rate hikes? Or do you think it's the long end, the 10-year, the 30-year, that will go down to, is it going to be a bull flattener or a bear flattener? And what would either of those cases indicate about asset markets?
It'll probably be a bull flattener. There's likely to be so let's talk about the next couple of Fed meetings. The next couple of Fed meetings, the Fed's there's a risk that they're going to go 50 basis points. I happen to think they are going to go 50 basis points because we're going to get a March CPI report between now and the Fed meeting at the beginning of May. We'll get those two inflation reports, and they're both going to say, guess what? Inflation momentum was unhinged in February, and it's even more unhinged in March. And so I think that's going to send a signal to the kind of the hawkish members of the board that, hey, look, we're right. We need to be moving faster, which, oh, by the way, is what Powell just confirmed in the NAB presentation he gave on Monday. So they're probably going to go 50. That going 50 And talking about QT, all that stuff might actually cause one final kind of repricing higher. If you look at overnight index swap markets and forwards in that market and Eurodollar futures and all that stuff, you might get one more kind of push higher in terms of the 2 year. But then from that point forward, you're getting into May and June and July when the growth slowdown is really going to start to materialize, at least according to our models. It's going to be very difficult for the long end of the curve to continue to back up, for rates on the long end of the curve continue to back up from that point.
Sorry, why is it harder for long-term rates to back up?
Because the growth slowdown will start to become more present to more investors, not just in the US, but also in Europe as well. And so the longer end of the curve is more quick to react to changes in the economy, because those changes in the economy have a longer lead time in terms of feeding into policymaker decision making. And so the 30-year will say, hey, look, the economy's slowing. I know the Fed will pivot at some point in the next kind of year or so. So let me start moving. And then the 10-year will start moving. And then the 7-year will start moving. And then the 5-year will start moving. And then the 2-year will start moving. That's how that process will work. So there could be a moment in time this summer where you have bonds rallying in price, but you still have the 2s and maybe even out to 5s holding up in terms of price, or holding up in terms of yield.
And how, a 7-10 spread, I hadn't heard of that before, but I was talking, I thought that the reason I hadn't heard of that before is because I'm young, I haven't been in the markets, but I was talking to Harley Bassman, who founded the Move Index, and Joseph Wang, who's a former senior Fed trader, and they're saying 7-10 spread, that's not a thing.
No, it's not. It's not a thing. Yeah, it's not.
Yeah, okay. Got you. But it is something that can presage a 2-10 spread, and that is definitely a thing.
Yeah, exactly. It's only a thing in the sense that, hey, when this happens, the thing we actually care about, which is the 2s10 spread and more aptly the 3-month 10-year spread, when the 7-10 happens, inverts, and all these other spreads inverts, it typically means that this other ones, the ones we actually care about, are going to invert. And so that's what I meant by that comment. I'm not saying please don't go out there and watch the 7-10 spread. I mean, you'd be better off watching paint dry and eating pizza. Yeah, the 3s10s, when that thing inverts, you're headed to recession. Like there is no ifs, ands, buts about it. We're obviously a long ways away in terms of that. But obviously 2s10s, as narrow as it is telling you that if the Fed stays on this course, they're going to get there, right? And they're probably going to get there sometime in the first half of next year. And so unless they speed up, interest rate hikes much faster than we anticipate, or guess what? The long end of the curve really starts to rally in the back half of the year while the Fed is, still out to lunch. And this goes back to our central thesis on asset markets, and which is, look, the inflation is going to come down, but it's going to remain elevated relative to both consensus and the Fed's forecasts. And as a function of inflation coming down, the Fed is going to remain engaged in tightening monetary policy. But guess what? The Fed is unfortunately going to have to tighten monetary policy until something breaks, because inflation is not going to come down fast enough it's not going to come down to a level that's acceptable before something breaks. So that, in our opinion, is why asset markets have to be the conduit, provide the feedback to the FOMC board to say, hey, look, stop what you're doing. Because guess what? If we get a recession, all those price concerns that we have, all that inflation we're worrying about and whining about right now, it's gone. Inflation kills inflation. And so eventually we expect asset markets to tell the Fed, hey, look, we're on the precipice of the cliff. Please stop tightening. You're going to push us over the cliff. And I believe that process is probably at least a couple quarters away, if not 3 or 4.
Recession kills inflation, but how long does it take to kill inflation? What if the European Union sanctions Russian oil and natural gas, and then also so that drives oil to $180? And also, by the way, you have a sort of a housing cycle where they only measure the shelter, the owner equivalent rent, 1/6 of a time. You know what I'm talking about.
Oh yeah.
So that it's already sort of baked in that we're going to have higher housing things, and that we get a CPI of 10% even as we do 50 basis points after 50 basis points after 50 basis points. Is that anywhere in your sort of calculation?
Absolutely not. If we go into recession, inflation's coming down, man. So things like, let's start by saying, hey, look, inflation is a lagging indicator. Wage inflation is the most lagging indicator, followed by actual inflation. Those things tend to peak just ahead of or in recession. So we know that inflation, when the recession starts, and we'll never be able to say when it actually starts until they come back and tell us and give us the official dates. The NBAR does that. But we have clues. We have our indicators, obviously PMIs and things like that. We can kind of guess So when inflation recession starts, and again, we're talking about recession like it's a certainty, right? If the markets go down by 35% and tell the Fed to stop quantitative tightening and hiking interest rates, we might not get a recession, right? So let's be very clear about that.
Really? So you think the faster the market falls, the less likely we have a recession?
Yeah, not just the faster, but the sooner.
Yeah,
So
yeah.
if the markets wait till late Q4 or early Q1 of next year to tell the Fed to stop hiking interest rates and quantitative tightening, then it's very likely we get a recession. If the markets tell the Fed to stop doing that in the fall, then probably we can avoid a recession. So it depends on how quickly will market participants get spooked by the growth outlook enough to say, hey, look, I got to sell stocks. I got to remove my participation from this asset class. I got to go buy bonds. I got to go do a bunch of things that send a signal to the Fed that the whole world is concerned about a real recession. And I think eventually at that point, at a certain price in the S&P, which again, our models are saying somewhere around down 30% from the all-time high, is that pivot point for power.
Darius, I've been following your work for a long time. You typically speak in very quantitative, rigorous, probabilistic terms that do not lend themselves easily to narratives. I have to say, Darius, right now you're definitely not certain. You're not certain about anything, but you're probably the least uncertain or the most certain ever. That's the way that you sound, at least right now. Would that be fair to say? Over the past year and a half, that you sound pretty convinced that in 6 months the S&P 500 will be lower. Like, how are you sort of handicapping it? How surprised would you be if the S&P 500 is at 5,000?
Oh yeah, no. So pretty convinced in 6 months that S&P will be lower. That is, I mean, there's no guarantee on that. I'm not convinced of anything in financial markets terms. I'm convinced of our views. I'm convinced of our forecasts, and I'm convinced of the market's historical responses to these types of impulses. And so, if the market has any sort of reasonable response to the types of impulses that we're forecasting from a growth, inflation, policy, and positioning perspective, then it's very likely we have those adverse outcomes in markets. But there's no certainty at all. I mean, I've been doing this for long enough to know that you're a fool if you try to put price targets out there. Or, that's just not how this business works. It's not how the game works. But the reality is, yeah, I am very very confident because again, I think we do as good as I think we have as good as a handle on sort of studying longer term economic cycles as anybody, as good as understanding of marrying that to markets as anybody. And quite frankly, we don't see these setups very often, right? Like March of '09 only comes around every so often. There's not that many March of '09s in the chart. You pull the chart back 100 years. There's not that many sort of, let's call it 99 2000s. If you pull the chart back 100 years. So there's a lot of things that are sort of coming together right now in this particular juncture that are pretty historic. And I don't want to mince words about it. They were historic to the upside. Again, going back to when we were I was as bearish as I sound now. You'll fact check me on this. I was equally as
I know.
bullish. I sounded equally as
Yes,
bullish
I
back
remember.
then. Yeah.
Fact is, actually, I remember where I was when I was editing the video.
Yeah,
And I was
exactly.
like, damn, Darius is pretty bullish.
Yeah, no, not pretty bullish, bombastically bullish. And
Yes,
so,
yes.
yeah, exactly. Now I'm bombastically bearish. And so, again, it's just the Bermuda. It's all rate of change process. It's all understanding where you are in these longer term cycles. And we're unfortunately in a very precarious place across a lot of various indicators. And not the least of which is a Federal Reserve that may be in a new regime relative to the one we just exited.
Mm. And so I asked you earlier, where can investors find safe harbor if bonds won't act as a hedge any longer? You said commodities. I think you said oil. You also said VIX futures. But you can't have a
Medium
commodity
term.
that's. What'd you say?
Medium term fixed futures,
Medium term
not
VIX
short
futures.
dated. Yeah.
Those can only comprise a small percentage of a portfolio because
Yeah.
they tend to have a negative absolute return. Definitely in the case of VIX futures. Is it just the case if you have to do some sort of not 60-40, but you add your special sauce on it, but it is still like you own some stocks and you own some bonds and maybe you do go into low beta, but it sounds like returns on financial assets, expected returns on financial assets are just lower than under other terms. Is that right?
They should be lower, right? We're starting
Yeah.
from a very high valuation. We're heading into a negative cyclical environment. We're heading into a negative structural environment. If you think about some of the supply shortages that might persist in commodities, you think about a Federal Reserve and an ECB that are no longer going to be holding our hands at every kind of wiggle in the stock market. This is a very different setup. So if you think about it from an asset allocation perspective, and again, I think risk managing sort of the very near term is a little bit different than risk managing the medium to long term. If you focus on the medium to long term, obviously cash is going to be a meaningful allocation to your portfolio. Like when you run out of stuff to buy, the natural residual is having an elevated cash balance. And so don't forget, as an investor out there, particularly again, this I'm speaking to retail investors here, you don't have to be a hero. If you didn't make enough money when Darius was bombastically bullish from fall of 20 through the middle of 2020 or through the fall of 2021, I'm sorry, you just missed it. You can't make it up now. There's no way to make it up now. Markets are going, they're in a very they're in a higher volatility state. It's just not going to be easy to make money. So ultimately, if you don't have real sort of thoughtful uses of your cash, real thoughtful ways to kind of play this. And again, I think that list of thoughtful kind of uses of cash is really narrow in this particular environment that I'm talking about. Then you have to have more cash. And if you're an institutional investor, obviously the name of the game in institutional finance is just, high grading, your credit quality, going up capital structure, going up the sort of a market capitalization structure, going into defensive, sector style factors and things of that nature. That's pretty straightforward. I think it's harder when you actually have to make the decisions on being in or out of whole asset classes.
What sector do you think are you the least constructive on? Let's see, you can choose from the consumer discretionary, I guess, which is sort of the hotels and stuff. But then there's also technology, which has not been performing well either. What are you most bearish on in terms of sectors?
I'll sector, if we're talking about GICS level one, I would probably say financials. Financials is probably the worst place to be if in this kind of environment, flattening yield curve, cyclical slowdown, potential recession, Fed nowhere near bailing you out. Like that's just not a good environment for the financials. From a industry perspective, I don't believe that we are very much sort of taking the under on the consensus expectation that we're going to have the services sector boom, a big U.S. economic boom in 2022. If anything, we think there's a high probability of a slowdown to a below trend state by the end of the year. So we'll be short, various sectors and segments within consumer to take advantage of that. But then I'm concerned about my friend Kathy Wood, because on one hand, we do believe bond yields are going to peak at some point this summer, in the springtime or in the early summer, and really start to go down. But they'll be going down alongside the stock market, and that's not an environment where you're going to want to go buy a high beta mid cap growth stock, as Kathy Wood is levered long to the gills. So I really feel for her. We're just not at the place in the point of the broader economic and market cycle where you're going to want to back the truck up on those types of exposures. So I just as soon think that we could see another 30 to 40% decline in ARK before this is all said and done, unfortunately. And I really do like Kathy. I think she's a nice person, so I don't wish that on her and her team, but it just is what it is.
And Darius, within the world of fixed income, what do you like? What do you not like? There's the short end, which I guess the ETF would be SHY, which is, I guess, 1 to 3 year treasury bills. I think that has been taking on a lot of pain. It's not that volatile, but those rates have been going up every single day. And then there's a long end, there's the belly, there's credit, there's high yield, investment grade. How are you sort of thinking that blend?
Yeah, so I mean, generally speaking, when you're trying to position for a growth slowdown or trend or simultaneous deceleration in growth and inflation, as we are set up to experience in the back half of this year, you're going to want to be in duration. Duration is kind of the best play there, or a levered sort of play on the short end as well. I think it's too soon to play for the short end because, again, I don't think the Fed is going to back off of tightening until the market tells it to back off of tightening. And so I think you're gonna miss the opportunity that you could actually make money with being long bond as opposed to being long the short end. But generally speaking, if we're heading into something that looks like a recession and the Fed is about to cut rates, as by the way, the euro dollar curve and the OIS curve have both have that inversion priced in. When the Fed is about to cut rates, then the best thing you can do is lever up the short end of the curve. There's no better return in financial markets.
Darius, my final question is about China. You recently wrote that Beijing must follow through on its rhetorical policy shift, and if not, FXI and KWEB are toast. FXI and KWEB being ETFs that own baskets of Chinese stocks. What did he mean by that?
Yeah, so going back to our crowding analysis, so let me start by saying, so a couple weeks ago, the sort of China Financial Stability and Development Commission or whatever, Li Hua, who's the kind of the economic czar of China, if you will, came out of that meeting and said, "Hey, look, we need to do more things to support the Chinese stock market." That catalyzed a massive squeeze and kind of the arc of China, basically KWEB, for lack of a better exposure. The catalyzed a massive squeeze in a lot of these sort of overly shorted, under owned Chinese equity assets. they didn't follow that up with actual easing. It was really just a rhetorical kind of pivot to say that they want to say support those things. And so, we went back and did a lot of work. We do a ton of work on China already. We went back and kind of, refreshed the models on some of these, kind of rhetorical policy pivots we've seen in China in recent years. And, going back to 2008, 2009, we saw one in 2011 through that, persisted into 2012, saw one in 2015 that persisted into 2016, saw one in 2018 that persisted into 2019, and then saw one in the spring of 2020. Of those 5 instances, only one, which is the 2011 to 2012, was a sort of buy the rumor kind of event. You typically, what you want to find in China is you want to see the actual easing take place, in which tends to happen over a span of multiple months, if not multiple quarters, before the sort of kind of positive effects are really felt, kind of broadly in the global economy and global equities and things of that nature. So this is why I say, hey, look, Beijing's got to follow through on this, because there's been this massive short covering trade in Chinese equities as a function of this rhetorical pivot. But if you actually study the cycles historically, that rhetorical shift is usually not the buy signal. The buy signal is when the PBOC is actually out there supporting growth, by expanding its balance sheet or by cutting policy rates, cutting reserve requirement ratios, cutting prime lending rates, et cetera, et cetera. They're not doing that stuff yet. In fact, this Monday was pretty disappointing as it relates to the loan prime rate targets. They actually didn't change those rates at all. So, the PBOC's monetary policy setting is still decidedly neutral. It's been decidedly neutral for an extended period of time. And it's going to remain decidedly neutral until we see something different. And right now we haven't seen anything different.
Darius, it's been great having you on Forward Guidance. Before you go, can you just tell us a little bit about 42 Macro, why you started it, and what you offer to investors?
Oh, I appreciate you, Jack. And it's been awesome to be on. I love connecting with you, my friend. So kind of the 42 Macro in a nutshell, man. The reason we started this firm is, I don't believe, my partners don't believe that institutional investors deserve a clear informational advantage, a clear timing advantage, a clear profit and loss advantage, relative to retail investors. Wall Street is sort of built on kind of maintaining these gates, these very high cost, high regulation gates on information and process and things that help you make money across economic and financial market cycles. And I don't believe in those gates. I want to make sure that, the average Joe on the street has the same opportunity to make money in financial markets that, some big major hedge fund, because again, it's all always boils down to understanding where you are in the market cycle, understanding where you are in the economic cycle, and marrying those two factors together to ultimately produce good outcomes for your portfolio. And I don't believe that is something that should be sort of, embargoed for, kind of, high price, institutional clients. I believe that everyone deserves that kind of information. And that's why we democratize it.
Well, Darius, thank you so much. And looking forward to having you on back soon.
Absolutely, Jack. Thank you so much for having me.
Yeah, Darius, when you come back, the 10-year was either going to be at 5 or -5.
No, it'll probably be back at 2 if I had to guess.
Yeah, you're probably right. Thanks. Thank you, and thank you, everyone.